Hello and welcome to The Real Bottom Line, the podcast for entrepreneurs featuring entrepreneurs. And today, our very special guest is Jennifer Williams. She is the founder and now partial owner of Fireflies, a company that specializes in employee ownership trust. And I can't wait to dig into that. So, welcome to the show, Jennifer.
Thanks. Thanks.
Oh, so good. I'd like to start a little bit first about if we could go a bit, how did you become self-employed? How did you become an entrepreneur? Have you always been one?
Great question. I have not always been an entrepreneur. I started my career in the not-for-profit sector,
Ooh,
actually,
one.
and in international development. And in the course of working in nonprofit and international development, I got tired of chasing the funding cycle. So whatever was in mode was what everyone was now moving towards. And I was like, this doesn't make any sense. And I started to see business as a tool to be able to achieve certain social and environmental objectives, but using business as a tool to get there. And so when I came back from I lived in West Africa for 3 years, working there on a microcredit project. And when I came back from that, I started working for a worker co-op that was working with fair trade and organic cocoa, sugar, and chocolate. Camino is the brand. And I became an owner of that business. I was the fifth worker owner to join the company. And so that was really my first foray into entrepreneurship. It was like, oh, I get to be an owner, but without having to be an owner by myself, which was really great. And that started that kind of entrepreneurial drive and spirit. Since then, I I was an owner of Camino for 10 years. And then I owned another organic and locally focused food business here in Ottawa for almost 12 years. And I'm now the founder of Firefly Insights, which is an employee-owned company. And so we've just employee owner into ownership as of yesterday. So that's all very exciting.
That is really exciting. What an interesting journey of like going from not-for-profit to almost social enterprise to affecting change in a different way with what you're doing now. I always look at every part of that journey for myself anyways. I take away key lessons, things I learned, usually from stuff that went wrong. But tell me, what were your biggest lessons from those enterprises that you were involved with in the past?
Yeah, I think one of the early lessons coming from not-for-profit and then working in social enterprise business was the first hard lesson was about the value of profit, right? And having come from nonprofit, having this idea that profit wasn't a good thing.
It's an evil word.
Yeah, exactly. And I really had to wrestle with that in my time at Camino early on, because I was like, if we're making profits, then we haven't done enough to support our mission or to support producers or whatever it was. And so I had to really understand, that was my first real lesson in business, is like understanding that balance between profitability and mission. And I think that's a hard piece for a lot of business owners who have mission as their focus, to find that balance between mission and profitability. So that was a big lesson learned. And then the other one has just been finding scale. How do you scale your business in a way that makes sense and is in alignment with your values and your mission? At one point, we grew our family-owned food business phenomenally, and then we were burning out, right? Like we have 4 kids and we were working all the time, and we were like, wait a minute, this doesn't make sense. We want to do. And so then we scaled it back down because so finding, I think, as an entrepreneur, you have a lot of opportunity. And the question is finding the right opportunities for where you're at in your life and what you're trying to achieve.
I love that. It's interesting when you talk about profitability versus mission. I see that show up sometime in underpricing yourself.
Yeah.
In the sense of your service is great, you provide great value, it's transformative, yet you're diminishing the value by underpricing yourself so that you don't have profit or what have you.
Yeah. And I think for a lot of women entrepreneurs, we live in a world where we haven't, just statistically, we are paid less in the market and our work is seen to be worth less than that of male counterparts. We do a lot of work that isn't compensated. And so I think it's hard for female entrepreneurs in particular to really step out and be like, yeah, I'm in alignment with my mission and I'm going to charge fair market rates for my work because I bring a lot of value to my clients.
But I also think profit can actually amplify your mission.
Absolutely.
So if you're making enough money, there's other things you can do It could be that you're cutting a check to a different charity because you can. So I think of profit
Exactly.
as an amplifier.
Agreed. Completely. But I had to learn that.
And that reprogramming is hard. Holy cow, that's hard because we were taught a certain way and then to change that belief system, but then not only that, but change the actions you're taking in behind that belief system. Like it's a double whammy that you got to do.
Yeah. Yeah, totally.
What do you think is
Yeah.
your biggest thing? If you said, hey, this is the biggest thing that helped me make that shift?
Good question. I think it's really looking at, so one of the things we did at Camino that I thought was really powerful was we developed something called a profitability fork. And
Oh,
basically we talked about like, this is the minimum amount of profit that we need to earn to be able to continue to reinvest in what we're doing and grow our business and all those things. But profit above 8, 9, 10%, that starts to become profit for the sake of profit. And so what we decided to do is that outside of that, if we had a fantastic year, not to say that we couldn't have a fantastic year, if we had a fantastic year and we hit 15% profit, then that difference between the fork, like the 10% and the 15%, would be reinvested back into the mission.
wow.
So for us, it was a way to keep the mission in check
Yeah.
while at the same time also being able to generate the profitability that we wanted to generate so that we could continue to reinvest in the mission.
Have you ever shifted the fork up in terms of what you required profitability was?
So I work with clients all the time when we're developing employee ownership schemes and we're implementing that and talking about where dividends get paid and how much gets held by the company and those kinds of things. And the reality is it depends on the business, it depends on the season, it depends on the market, right? So they do need to be dynamic. And it really depends on, we're in a very volatile market right now. So if you're in a volatile market, you want to have more profits being banked, right? So that you
Right.
have future flexibility as an example.
Yeah. I think also I call that cash hoarding sometimes, and I'm all in favor of cash hoarding to a certain point because it can really give you that peace of mind, even to try different things and know that, hey, this might not work, but it's okay because I have this cushion to allow me to try
Yeah.
things.
Yeah, exactly. As long as you don't go offside and have too much cash that CRA now
Oh,
thinks that
absolutely. Yeah.
they have to tax you at a higher level. Yeah, yeah,
Yeah.
yeah.
So there's all these rules, and then we use other structures and places to put it, etc. So yeah, it's good. All right, so those are some great lessons. Profitability, our mission, finding scale. When it came to finding scale, I think that's something a lot of people struggle with too.
Mm.
Did you come up with a philosophy around that?
Again, so all three businesses that I've been part of that I've owned, they've all been slightly different. And so
Mm,
I think it's also a question of what does scale mean for the business you're in? And
mm,
so I'm currently in exploration of that for Firefly Insights because we do consulting for clients who want to implement employee ownership, which is very
yeah.
hands-on, time-consuming, right? And so in a world of AI and in a world of what does that look like at scale? How do we provide value to people and how do we scale that? So that's something I'm working on currently, but it depends on the business that you're in, I think.
Yeah.
Yeah.
Okay, cool. So let's start digging into the employee ownership trust piece. So, people who have been listening to this podcast know I like to talk about succession planning and transitions and planning for your ultimate exit. And there are at least five different things you can consider. One, of course, is family. Second one is employees and management. Third one being maybe you're going to become chair of the board. Fourth one being sell to a third party. And then, of course, if you're super ambitious, maybe you're going to scale and go IPO. But
Mm,
so I think where yours fits really nicely is in that employee slash management side of things in terms of using this as a tool to maybe start crystallizing some of your gains and also really thinking long term. So I'm fairly new to this field, Jennifer. So I am looking forward to being educated. Tell me what it is. Who's it for?
yeah, great. So the employee ownership trust legislation is brand new legislation as of 2024. And it is for mid-sized, largish small companies. So at over 5 million in revenue,
Okay.
right? So more mid-sized companies with stable cash flow who have a group of employees who could continue to run the business for owners who are looking to exit or to at least give up control.
Mm.
Because one of the things about the employee ownership trust legislation is it does require a transition of 51% of the business to the trust.
And these are voting shares, not just dividend paying shares then.
Yeah. So the trust becomes an owner of the business. So what's different about a trust and a management buyout or an employee share ownership plan is that the trust is the shareholder. And then the employees are the beneficiaries of the trust.
Okay.
So it's not like every employee is then a shareholder. You could also do that. You could set up an employee share ownership plan and every employee could be a shareholder. But in this instance, the trust is the shareholder and the employees are the beneficiary. And the way the legislation works is that all employees, once they've been employed with the company for a year, have to be named as beneficiaries. So regardless of the type of business you're in, if you're in a manufacturing company and you have there's rules around temporary versus permanent and those types of things, but basically permanent employees of the company need to be named as beneficiaries of the trust. It is structured so that typically, so employees are not paying for the shares. This is the really big difference in the legislation. If you want to do a management buyout, your employees are going to come up with the cash, or they're going to get financing, or the company's going to take financing, and you're going to get paid out. In an employee ownership trust, the owner must sell at least 51%. That can be bank financed. So a lot of different financial partners will come to the table to finance that. That's why you need stable, consistent cash flow. And then usually the owner will take as much as can be financed up front and the balance in the vendor take back note over time.
Can you just
So
real
it
quick
does.
talk about what a vendor take back note is?
Yeah, absolutely. A vendor take back note is basically a loan that you're sending to your employees that they're going to pay you back over time to get that money. So if your company's worth 10 million and a $5 million loan comes in, you get 5 million upfront. The balance, the other 5 million would come over time as a loan paid out to you by the company.
Okay.
And so it requires patience in terms of getting all of your money out.
Mm-hmm.
And so what the federal government has done is they've recognized that this requires a transition of control, which is risky, and time to get paid out fully, possibly time to get paid out fully. And so they're incentivizing it with a $10 million lifetime capital gains exemption. And I know from the business owners that I'm working with, that helps to offset those disadvantages, right? Like those are disadvantages. But if you were to sell to a third party, you might have a buyout based on certain results. Like you might get 70% upfront in cash and then a balance over time. You may have terms and conditions tied to that. Like every deal is different. So the 10 million lifetime capital gains exemption is there to try and incentivize business owners to sell to their employees, to not have it be disadvantageous, and to keep those businesses Canadian owned and operated.
So
Because
I just couldn't insert for a second. So just to be clear,
yeah,
that takes my personal capital gains exemption of 1.25 and blows it up to 10 million plus if this system works for me.
yeah, and you still have the 1.25 available to you. So
Oh,
now you
I
have,
don't lose that. I get it. Oh, no. Okay, I'm liking it.
yeah, yeah, exactly, exactly, yeah. But you can save $3 million in tax almost on selling your business in this way. And the incentive for the Canadian government to do this is that if we sell the majority of our Canadian companies to foreign buyers or US private equity, then what's the Canadian economy going to look like in the future? Right. And all of those jobs and spin-off jobs, right? So I was talking to a banker recently from one of the major banks, and she said, yeah, like I had a client who sold their company to a US company, and within a year, all of their banking was done with the US bank. All of their insurance was with the US insurance company, right? Like all of those services that support the Canadian economy, like the ripple out effect of that is really important. And so this is part of why the legislation to keep
I
businesses
also think
Canadian
it's
owned.
super important. One of my theories and why I do these exit labs, so I'm doing it in urban centers right now, but I like to do it in rural centers because I feel
Mhm.
like that ripple effect is amplified because they're an employer, they have everything. So if they just close up and go away, there's employment gone, a key service gone, all kinds of that their economic ecosystem takes a bigger blow than if that happens in in an urban center.
Absolutely. Yeah. You lose a large employer in a rural community and everyone in the community feels it.
Yeah,
Yeah.
yeah, exactly. That's interesting. I have some almost technical question because this my
Okay.
curiosity is piqued because I didn't do a lot of research on this beforehand, just because I wanted to
All
be
good.
come in with an open, curious mind. So I implement that piece. Do I have a shareholders agreement with the employee ownership trust that details some of how everything's going to work?
Yep. So if you, let's say you sell 51% and not 100% or 80% or whatever percentage, yeah, you would still have a shareholders agreement to determine how that all is governed.
Am I able to use the employee ownership trust almost as a golden handcuff? Or is it so strict? It's just here, they're in, they're out. There's no way. Is there a way to structure it to hold on to key employees longer, better?
So the employee ownership trust is designed so that when you're in, when you're out, you're out. That said, once the loan and the owner is paid out, the profits of the company are going to flow to the trust in dividend form and then out to the employees. And if you're a $20 an hour manufacturing worker on a shop floor, and now on an annual basis you're getting dividends from the profits of the company, you could call that a golden handcuff, or you could just call that a benefit of working somewhere where you
Yeah.
get to share the ownership. But that's part of the goal, is to be able to share out the work so that everyone in the company who's working there is benefiting from it. In employee share ownership plans, which we also design and implement, there are ways that people have designed them to try and keep their core team,
Yeah.
that you want to keep your key people and you want to find ways to do that. So there are ways to do that as well with the employee share ownership plan.
Oh, interesting. With regards to, so 51%, just as, for example, let's say it's 100 employees in there. How do they exercise their rights as owners? Is there one person they elect? Is there a board they elect? Like, how is that managed? Part one. Part two, declaration of dividends. Like, there's the push and pull of paying them out
Yeah,
versus reinvesting them in the company. Talk to me
great
about
question.
those things.
Yeah. So let me give you a high level on governance. So within an employee ownership trust structure, you would have two main governance bodies. One would be your board of directors,
Yeah.
which would play the role that a board of directors typically does, the fiduciary responsibility, strategy, those types of things. You would also have a board of directors, and your a board of trustees.
Board of trustees. Oh, that's new to me.
Board of trustees.
Okay.
Yeah. And so your board of trustees would be comprised of typically one independent, one employee representative, and one of the founders or an appointee of one of the
Mhm.
founders. And so the board of trustees then represents the interests of all of the beneficiaries of the trust. So that's that mechanism. In terms of balancing reinvestment versus the payout of dividends, this is something that I usually encourage companies to come up with a policy for.
Wow.
And then it would be a board of directors decision on what the declaration of dividends would be on an annual basis. Because you absolutely have to have reinvestment and
Yeah.
you have to have money that you're putting away. And so that would be, and a lot of what we do is also the education and communication around how is this going to work so that people understand why you reinvest and
Mm.
what that means.
Yes.
But yeah, so usually we recommend a framework that is generally applied on an annual basis.
What do you find is the hardest hurdle, number one, for employees, and number two, for the owners to overcome mentally around this structure?
Hmm. Good question. For employees, because the trust model is so different in terms of the beneficiary versus the shareholder, that's the mind shift that takes a little while to figure out.
Yeah.
And I'm working with a company that we're in the process of launching, and that's been the piece where people are like, okay, but I'm not right. I'm not the direct shareholder. I don't these aren't my percentage shares. I am a beneficiary of the trust. So that's the biggest mind shift.
Yeah.
For owners, I think for a lot of owners, there are questions around, there's always, as in the work that you do, right? Like the when you've spent 20 or 30 years building a business, there's an emotional attachment, there's an identity that comes with being an owner of that business. One of the things I really like about employee ownership as an exit plan for business owners, it'll allow a bit more of a gradual exit,
Yes.
right? If you sell to a third party, different. If you sell to your employees, you can continue to have a relationship and you can continue to have kind of like those synergies in different ways and you can be involved in governance.
Like
So I think
talking to
that,
the system. It's always
yeah,
of a shock, but less of a shock.
yeah. And so then I think that the issue that we typically find is more the question of letting go
Mm.
and trusting the next generation, right? Because they will do things differently and they'll make mistakes that you already made and you can try and tell them the same way you try and tell your kid, like
Yep.
don't do the thing and they'll do it anyway. I think that is challenging for people and it takes time to kind of build that trust and confidence to be able to hand that over.
I think that's true no matter how you transition your business,
Mm.
that you have to be working on that because the ideal business is actually you're not, as an owner or founder, you're not involved in the day to day long time before transition so that you're actually selling something that's more of an asset than something that you are a bottleneck in.
Yeah.
Okay, I have another weird question. So the organization has some debt, and maybe
Mm.
the current founder has personally guaranteed that debt because that's the way of the world here in Canada. So,
Right.
how does that happen? Is the trust now personally guaranteed as well? What happens?
That's a great question. That is one of those messy areas still,
Mm,
and it really depends on the lender.
uh,
Typically, we work with the lenders to not have the personal guarantees attached, which is why we want those kind of mid-sized companies with stable cash flow so that they don't have those personal guarantees. It tends to be a bit of a case-by-case situation.
so it could almost be that whatever the influx of cash is, you get rid of the loans as part of that, as part of the process, maybe. I don't know many banks that at the 5 million in sales line are letting people off the hook from a personal.
I know. It's tricky.
Yeah.
It's tricky, and this is one of those areas where, the education as well with the financial institutions that are coming to the table on this and in terms of how this functions has been important. And so that's been,
Yeah.
there's definitely, they understand it, but it's a change. Yeah.
So are you dealing more in the commercial credit department than, say, even the business account department from the education perspective? Like, where does it mostly need to happen?
It's a great question. I spend a lot of time talking to commercial bankers and yeah. And again, it's a mind shift for them as well. It's a different model.
So if you get a loan on behalf of the trust to pay the guy out, that's the part where you're trying to avoid any personal guarantees because the trust would be the action. Would the business be the signer of the loan or the trust?
So it depends on the exact structure. Usually what happens, because sometimes there's also a holdco structure in between to make it more tax effective. So dividends can go to holdco and pay out the loan. So we usually work with the lender to have, of course, you understand that the business is behind the loan,
Yeah.
right? Because that's where the historical track record comes from. But there may be another structure such as the trust or the holdco that's in play that facilitates that actual loan agreement.
So basically, once an employee leaves or retires or whatever, they're just out of the whole sitch, and whoever comes in behind potentially is now part of the trust.
Yeah, exactly.
Okay, cool. Oh, this is such an interesting area. So here's what I've heard so far in terms of the ideal business owner that could potentially consider this. They're 5 million plus in sales. They have very stable cash flow. Is there a number in terms of number of employees that it makes sense? Now, you just did it for yourself, so it's just so obviously it can be any number of employees.
Yeah. For yeah, you can do an employee ownership model for any number of employees. Typically what we see is over 10 is where most people will start, but you can be a smaller group than that.
Yeah.
Yeah.
And with regards to the industry, do you see this applying better in certain industries? Are there industries that are exempted from this model? Give me some give me some details on that.
Yeah. So there are some exemptions around the lifetime capital gains and the trust model as it's related to certain professional services like dentistry and veterinarian clinics, medical doctors, because of the way their professional bodies
Oh, the
work.
bodies more so than the anything else. Okay.
Exactly. So there is an exemption around that. outside of that, this can be applied within any industry. What we find it very commonly used in is service companies, where engineers, architects, consulting companies, where your people are your real assets and you want to keep those people, and this provides a great opportunity to do. But it's also a great tool in manufacturing. Like, we're talking more and more to light manufacturing and those medium-sized companies that have built up this company in Canada that can then transition to the next, to the employee generation. And then was there another part to that question?
I think you got it. It was more along just who's this for? Was it service or manufacturing? Like and who doesn't, who's not eligible? So you cleared that up fairly nicely. What is the biggest misconception? Like, it's a new term. It's only we're only in it a year or so, but there's some misconceptions out there already, I believe. Like, when we first talked, I'm like, I don't think it's good for anyone. And you're like, Wendy. So based on that,
Yeah.
what are some of the misconceptions out there that we should be aware of?
I So I think that the number one misconception around employee ownership is that if you have employee ownership, it means that everybody in your company is making all the decisions all the time, and that's just chaos, and nobody wants that. And that's not what it means, right? We set up governance structures so that your company is governed and managed in the way that your company is governed and managed, and that is separate from having these employee ownership structures. And so I think there's this, people are like, I don't want all the fingers in the pot. And so I think that's the number one misconception. And so if you can take a step back from that and say, look, we're going to have a structure that allows us to manage the company and to still make decisions quickly as we need to make them, and to have the right decision-making frameworks in place and the right people at the table, you can still do that. It is not, it's not, yeah. So I think that's the number one thing. Outside of that, employee ownership has been really beneficial for companies. Statistically, employee ownership structures have been very well documented in the UK and the US, and they are very good at growing profitability, growing revenue,
Do you see
maintaining employee
more
retention.
presenteeism? Do you see more engagement? Do you see less sick?
Yeah,
All those things, do those manifest?
all those things. You retain your people longer. People are more motivated in their work. They make better decisions. Like, all of those things unlock when people are aligned to the same goal of being owners of the company and benefiting from that ownership. And so those are some really powerful shifts that can be made as well.
It feels, if I were doing an employee stock ownership or an ESOP versus an EOT with the ownership trust, it feels like I'm going to do the same amount of upfront work, but it feels like the trust might be more flexible when people cycle out for any reason.
Yeah, it depends on how it's designed,
Yeah.
because you can do the same with an ESOP. But yeah, the legislation is quite clear in how that operates. The number one thing it does is it takes the burden of buying the business off the employees and creates a different mechanism by which to do that, and incentivizes with tax. That's the real main difference.
Yeah. And you wouldn't, if you're an employee buying a business, it becomes more about the group as opposed to an individual being financially underwritten to do the purchase versus it's more the business funding it.
Exactly.
Okay,
Yeah.
cool. That is awesome. Oh, quick question. I've already done some planning. I did almost like a freeze. I've done the preferred share thing. I now have my family trust in place. I have a hold co in place. Does that rule me out for this?
Yeah. So we'd have to look at your particular structure. The family trust is that adds complexity to this. It makes that challenging. The hold co is okay. So we would just need to look at the specifics of how you've got that designed.
Can you undo any of that stuff if you've decided, oh, this
You
is the
can
thing I really want to do?
You can always undo it. And one of the things that is currently in the legislation is the 10 million lifetime capital gains has a sunset right now of December 31st, 2026. But I was in a meeting on Tuesday with the MP that is bringing to the table recommendations around removing that sunset. And so our hope, and there's a Social Capital Partners has been amazing at putting this legislation together and getting in front of the right people. And so the recommendation and the hope is that in the budget announcements in October, that sunset will be removed. So therefore, you would have time to unwind some of those structures that you have
Yeah,
set up
if you
and
want.
prepare yourself. Yeah.
Amazing. Anything I didn't ask you that I should have asked you?
I think the only thing would be, as a business owner, if you think about leaving your business to your employees versus selling to a US private equity firm and what that's going to look like in 5 years down the road and how that feels to you. I think that's just the one thing that's sometimes worth, as a business owner, thinking about and reflecting on, like, how much is some additional money worth what that feels like down the road.
It's a if you will, because
Yeah.
with the employees in control, it feels like your legacy might continue, whereas it's more up in the air if faceless party buys it.
Yeah, absolutely.
Jennifer, how can people get a hold of you?
Yeah. Jennifer at fireflyinsights.ca.
Awesome. Thank you so much for your time today. I think the real bottom line here is as you are thinking about transitioning, there are so many options and you need to explore them all before you make your decisions. Thank you so much for your time, Jennifer.
Pleasure. Take care.